It wasn't a speculative frenzy. It wasn't a geopolitical fear trade. It wasn't even a reaction to a single earnings report or a specific election poll. It was the realization that the arithmetic of sovereign debt has reached a terminal velocity. The recent simultaneous surge in Bitcoin and the breakout in silver prices are not random market noise. They are the mechanical response to a fiscal trap that has no painless exit. We are looking at a mathematical inevitability. The pattern is unmistakable. When a dominant power reaches the limit of its ability to service debt through taxation, it turns to the printing press. This creates a signal. First, it is faint. Then, it becomes a siren. Smart capital hears this siren first. It moves quietly into assets that cannot be printed by decree. This is the phase we have entered. The $3 trillion trap refers to the scale of liquidity required simply to keep the current system solvent. It is the cost of maintaining the illusion of stability. But history shows us that this illusion always has an expiration date. We can trace this exact sequence through 3 distinct empires. The names change, the technology changes, but the incentives remain frozen in time. To understand why digital assets and precious metals are moving in lockstep, we must look backward. We must look at the Roman Empire. Specifically, the period beginning with Emperor Nero in 64 AD Rome was the unipolar power of the Mediterranean. Its dominance was unquestioned, but its costs were spiraling. The empire had ceased expanding, meaning the influx of plunder had stopped. Yet the costs of the legions, the bureaucracy, and the grain dole for the citizens of Rome continued to rise. Then came the Great Fire of Rome. The cost to rebuild was astronomical. Nero faced a choice. He could raise taxes on an already squeezed population and risk rebellion, or he could cut spending and risk the loyalty of the army. He chose neither. He chose the third option, the monetary shortcut. Nero ordered the mint to reduce the silver purity of the denarius from 100% to roughly 90%. He slightly reduced the weight of the coin. On the surface, nothing changed. A denarius was still a denarius. It bought a day's labor. It bought a measure of wheat. But the signal had been sent. The restraint was gone. Over the next centuries, subsequent emperors repeated Nero's trick. They had to. Marcus Aurelius faced wars on the Danube. Septimius Severus raised military pay to buy loyalty. By the time of the crisis of the 3rd century, the silver content of the currency had collapsed to less than 5%. The coinage was merely bronze dipped in a silver wash that rubbed off. After a few transactions, the result was a flight to hard assets. Merchants refused to accept the coinage at face value. They demanded payment in goods, in land, or in old, heavy silver coins from the Republic era. The middle class was wiped out. The complex trade networks that spanned from Britain to Syria disintegrated because there was no trusted medium of exchange. The Emperor Diocletian eventually tried to fix this with the Edict on Maximum Prices in 301 AD. He set price caps on over 1,000 goods. He mandated the death penalty for anyone selling above the official price. It failed. Goods simply vanished from the markets. The economy collapsed into a primitive barter system, setting the stage for the feudalism of the Dark Ages. Just like the Roman debasement, the Spanish Empire in the 16th and 17th centuries fell into a trap of its own making, though the mechanism was slightly different. Spain did not clip coins. Spain found a mountain of money. With the discovery of the massive silver deposits at Potosi in modern-day Bolivia, the Spanish crown believed it had discovered infinite wealth. Galleons laden with silver crossed the Atlantic year after year. The Spanish Habsburgs used this silver to finance endless wars across Europe. They fought in the Netherlands. They fought the Ottomans. They fought the English. They built the Escorial and patronized the arts. But they misunderstood the nature of money. Money is not wealth. Money is a claim on wealth. By flooding the European economy with silver without a corresponding increase in the production of goods and services, they engineered the price revolution. The cost of living in Spain skyrocketed. A fanegar of wheat that cost a few maravedis in the early 1500s cost many times that by the 1600s. Spanish industry was destroyed because it was cheaper to buy goods from France or England than to produce them domestically. The influx of silver masked the rot. It allowed the crown to borrow heavily against future silver shipments. Bankers in Genoa and Augsburg lent vast sums to King Philip II, believing the silver would always flow. But the costs of empire grew faster than the mines could produce. The arithmetic asserted itself. Philip II, the most powerful man in the world, declared state bankruptcy in 1557, then again in 1575, and again in 1596. Each time, the Spanish middle class and the lower nobility who held government bonds were wiped out. The smart money had long since moved into land and titles, insulating themselves from the monetary chaos. The Spanish economy hollowed out, leaving a fractured society where the productive class had been priced out of existence by the very silver that was supposed to make them rich. Just like the Spanish reliance on illusion, the Weimar Republic in early 20th century Germany demonstrates the terrifying speed at which a modern industrial economy can unravel when the currency is weaponized. We often focus on the wheelbarrows of cash in 1923, but the trap was set years earlier, in 1914. At the outbreak of World War I, Germany suspended the convertibility of the mark to gold. They believed the war would be short and that the defeated Allies would pay the bill. They were wrong. The war was long and Germany lost. Saddled with the crushing reparations of the Treaty of Versailles and a decimated industrial base, the Weimar government faced a critical shortage of hard currency. They could not tax the starving population enough to pay the reparations, so they printed. The Reichsbank, under the direction of Rudolf Havenstein, believed that printing money was necessary to keep the economy moving. They viewed the rising prices not as a monetary phenomenon, but as a supply shock or the fault of greedy speculators. The incentive structure was perverse. Industrialists borrowed heavily in marks, used the money to buy hard assets like factories and mines, and then paid back the loans with worthless paper. They became the kings of inflation. Meanwhile, the middle class, the teachers, the pensioners, the civil servants saw their life savings evaporate. A lifetime of thrift was destroyed in a matter of months. By late 1923, the price of a loaf of bread was measured in billions of marks. Workers were paid twice a day and rushed to the shops to spend their wages before the prices rose again. But here is the key detail often missed. During this hyperinflation, the stock market in nominal terms soared. It went parabolic. But in real terms, in gold terms, it was volatile and treacherous. The only true safety was found in what the Germans called substance values: gold, foreign currencies, land, and even pianos or works of art, anything that the government could not print. The society fractured completely, wiping out the moderate center and paving the way for extremism. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The nation is rising, productivity is high, and the currency is backed by something tangible or by rigid fiscal discipline. Stage 2 is expansion. The nation takes on obligations, wars, social programs, or imperial overreach that exceed its immediate tax revenue. Stage 3 is the debt overhang. The government borrows to cover the gap. The debt grows faster than the economy, but confidence remains high because of past glories. Stage 7 is collapse and reset. The system becomes unstable. The currency is rejected or redenominated. A new monetary standard is established, usually wiping out the holders of the old paper debt, just like the stages observed in Rome, Spain, and Germany. Current data suggest we are transitioning deeply into Stage 6. The warning signs are flashing in the bond market and the commodities sector. The United States federal debt has surpassed $34 trillion. More critically, the interest expense on that debt is approaching $1 trillion annually. This creates a vicious feedback loop. To pay the interest, the Treasury must issue more debt to keep the interest rates on that new debt from crushing the economy. The central bank is incentivized to provide liquidity. This is the trap. There is no mathematical way to pay off the principal in real terms. The only path is to monetize it to inflate it away.